Hello, this is Dr. Duru from Ahan Analytics with the market breadth. This week was action packed. We had earnings, which was the thing I was mainly focused on, and the resulting trading action verified for me why it was important to ignore the bearish signals from market breadth last week. I'll get into the charts to demonstrate the validation, but suffice it to say that this market is just as bullish as ever, despite market breadth not confirming the overall strength from the pricing action in the indices. What we also had last week was the Federal Reserve. It was Chair Jerome Powell's last meeting as chair, last press conference as chair. He even at the end of the meeting said, "I won't see you later." Little bit of humor there in a meeting that actually was kind of filled with some tension if you really read between the lines. I don't have time to get into all of this. I hope to write about it in the Inflation Watch blog in coming days. But suffice it to say that the market pretty much ignored the hawkish implications of what Jerome Powell was saying and the hawkish implications of the dissent in the Fed. Just read the Inflation Watch blog if you want to get more. Let me move on. The economy also had some important signals. GDP, looked fine, but inflation it's been sticky for a long time. The market, of course, has been completely ignoring the inflationary pressures in the economy, but it seems like it could be heating up. The longer the war against Iran goes, in particular, the longer the Strait of Hormuz stays closed, the closer we get to the disruptions that are going on in the global economy affecting the U.S. economy. And one of the biggest effects will be on inflation. Not just oil, not just gas prices. We've already seen those go way high. I'm talking about the supply chain disruptions that are being caused by a whole bunch of cascading effects. So anyway, let's go ahead and get into the charts. Like I said, the main theme here is that the market is bullish despite the ongoing bearishness in market breadth. So there's something to continue to stay wary for. And I think after earnings season is over, after we get through the thick of it, the weight of a negative market breadth will come to bear. And in fact, the charts I'm going to show you, it's not just a bunch of bullishness. There is actually a very bearish tint to some of the earnings results, the responses to earnings that I saw as well. And then there was also a very gratifying chart that I'm going to show to you. Anyway, I know this video is very long. So if you want to just skip ahead, just go down to the captions. I put in a timeline and you can go right to the stocks or ticker symbols of interest. All right, let's dive right in. All right, here is my favorite technical indicator, the percentage of stocks traded with their 50-day moving averages, what I like to call AT50. So as a reminder, here is the bearishness, right? According to the AT50 trading rules, a fade from the overbought threshold at 70% is bearish. And you can see market breadth pretty much continued to fall all the way into the and through the Fed meeting on Wednesday and then rebounded sharply. This rebound does not invalidate the bearishness. In fact, it's not invalidated until AT50 gets above the 70% threshold. So right now it's at 63.7%. And what I think it's at risk of doing is rallying just enough to get back to the overbought threshold and then pulling back. So that is bearish. And in fact, what's interesting is if you look closely here, and I'll draw a big old arrow, AT50 got to the same spot. Do you see that there? That it got to here. By the time it got to that point last time, earlier this year, the bearishness was pretty much irresistible. And, the indices, of course, fell sharply from here. So it is a good sign, at least for the short term, that AT50 rebounded from the lows of this week. It's interesting to see how quickly the market sentiment changed from the day of the Fed to after the Fed. And I'm going to attribute this mainly to optimism about earnings results. AT200, the percentage stocks trading above their 200-day moving averages, is the same thing. It's kind of stuck It rebounded, but it's still stuck at this level here, 55.9%. This is the level of the S&P 500's previous all-time high in early 2025, I believe it was. So again, I'm still concerned about the tepid trading action for this longer term indicator of the health of the stock market. All right, let's go into the indices. This is the S&P 500. Like I was saying, the S&P 500 made multiple all-time highs this week on Monday, Thursday, and Friday. And again, it's interesting to see how delayed the market's reaction was to the Fed meeting, because on Thursday, the next day, it zipped up 1.0%. And now let's zoom in here. Let's look very carefully, because there was this intraday fade right here. And I'm going to change the color on that, of course. So you see that intraday fade right there in the middle of that circle. That is a little bit concerning. What we don't want to see is to see the index continue lower from there. Okay, so that's the key thing that we're looking out for on the S&P 500. Let me just change that color to black for now. All right. Okay. NASDAQ. NASDAQ again looks much better. No, I shouldn't say much better now, but it looks better than the S&P 500. It also made a new all-time high Monday, Wednesday, Wednesday, Thursday, Friday. But now the reason why I said it's not a lot stronger is because if you see here, notice how the NASDAQ actually faded below, actually, and retested the intraday low from the post-Fed day. So that's these points right in here at this bottom point right there. So tech actually looked like it was about to lead the market lower, and instead the next day gapped higher and ended up 0.89% or 0.9% for Friday. So new all-time highs there for the NASDAQ again. So again, the S&P 500, NASDAQ look as bullish as ever. IWM, the ETF of small caps, made its new all-time high marginally, but it's still an all-time high. So it's breaking out of this consolidation period box right here. And of course, you want to see the box, don't you? I'll just put the box right here at the, let's do the open. So right there, just a marginal breakout. And so, of course, what I want to see is it to continue up higher. I did my standard. Actually, I still hold the call options I mentioned last week, so now I'm going into the coming week with just the long side of that vertical call spread. All right. The VIX confirmed bullishness. It particularly on Thursday, it faded hard with a what was this, about a 10% loss, and but the next day it held firm. So that was surprising given the all-time highs, but maybe this is a result of the S&P 500 fading. Again, what is this vertical line here? This is where the VIX was right before it soared ahead of the tariff drama and trauma last year. So what we want to see is the VIX break down below this to confirm the bullishness in the overall market. So that's kind of the tension that's waiting for us right there between the VIX not quite reconfirming the bullishness and the bearishness that still exists in market breadth. All right, let's get through the charts. I'm going to do this super fast style, so hang in there with me. NVIDIA, ticker symbol NVDA, looking toppy again. You can see it had this nice bullish breakout above the all-time highs, and made a new all-time high. Sorry, I should have posted that in there, but it faded hard. And why did it fade hard? On Thursday, it was thanks to Google. And I'll show its chart soon. Google's talking about making its own chips for its TPUs. And I don't know why NVIDIA sold off like this, 4.6%. You can see down here, it was on very high trading volume. This is kind of old news. Google's been talking about this for quite some time, but for whatever reason, I guess either the manufacturer of these chips looks more real than ever, and or the market is just in the mood of caring all of a sudden. So now NVIDIA looks very toppish here. It's going to take a lot more buying power to get back above this high. So I have to say, even though NVIDIA is well above the 50-day moving average, is the red line, and the 200-day moving average is the blue line, it's actually bearish right now. And if it continues down, you want to see it hold this support line right here. This support line was the former all-time high, okay? And so if you like pairs trades where you go long something and short something, NVIDIA looks like it actually could be the a prime candidate for the short side of a pairs trade, because either NVIDIA is going to drag the whole market down, or if NVIDIA rebounds, it's only going to be because the larger market supports it. On the other side, Micron Technology, MU, doing quite well. New all-time high. The double top long ago invalidated. You can see here it didn't really get to any natural support line when it bottomed out, but the war headlines were enough to let Micron's rally continue. So that's as bullish as ever as well. ARM, ticker symbol ARM, ARM Holdings. I just wanted to show this because this is a classic. This is a classic example. I've done this a few times already because the market's been so strong, where you can buy a breakout, an important bullish breakout. So this is the breakout above the previous all-time high. And you can see if you bought it here, you could have rode this stock from, let's just say 188 all the way up to 234. And even if you got caught by this gap down later, you would still be pretty good. Now, notice that ARM did eventually reverse all of that this entire gap, and now it's been creeping higher. Earnings coming up next week, so I am very curious to see whether ARM can hold these gains through earnings. Rambus, this is like old school tech semiconductor, ticker symbol RMBS. It was looking really good. This is where a breakout to an all-time high can really fool you. So I always say that technicals cannot be used to predict earnings, but they do set good context. So here you can see Rambus was on a very high streak, and was overextended ahead of earnings. And then look at this. The stock mysteriously, and I'm putting that in air quotes, sold off 10.8% ahead of earnings. That was a big red flag. And then the stock gapped down and lost 21.3%. On earnings down here. So, I mean, despite the big losses overall, the stock is still bullish in a sense because it's above its moving average, its major moving averages. But I'm not going to chase it here. I want to see it stabilize. I want to see it do a formal test of the 50-day moving average. You can see it almost did it here at the post-earnings low. But I want to see a formal test and then Rambus jump back up before I even dare to buy into this, because this could be the sign of some topping action for Rambus. All right, Microsoft, ticker symbol MSFT. I've done a short on this. I was making the case that what we want to see is Microsoft making a pattern of higher highs and higher lows. It fell 3.9% post earnings, but now it's bouncing. If this is the low, then that means this breakout holds. I talked about this breakout. It means that both this breakout holds and the 50-day moving average support holds. And this would mark a higher low because this was the previous low. And this would be the first higher low. And then, of course, what we want to see is the next higher high. There are two higher highs here. So this is a very slow-moving bottoming process, but it's looking very, very encouraging for Microsoft. FICO, ticker symbol FICO. Sorry, Fair Isaac Corporation, ticker symbol FICO. It's stabilizing. It survived an earnings report. You can see it's had some big down days. This on April 10th, it was down 14%. And then over here on April 22nd, it was down another 6%. So it was looking pretty bad for earnings. And yet the stock, it was kind of a non-event. So if I look back here, this is a reminder. FICO used to be a very strong performer. It's in this breakdown period. It peaked way back in late 2024. So it's not a stock that I'm going to buy back into, but I keep checking in on it. The big news, and I forgot to mark it here, sorry about that, is that they have a true competitor now that's being sponsored and supported by the FHFA. So FICO has a lot of work to do to to get competitive. Twilio, ticker symbol TWLO, another software stock, zoomed 23.8%. I'm not sure how I missed this one. This is, I guess, one of my biggest misses of the week. I'm not sure whether I would have stayed in for earnings, but the setup, so, the stock has been very choppy, but all along the way. It's kind of pivoted around its 200-day moving average, the blue line. And then it finally had this great test here where it dropped sharply at the beginning of April, but then bounced right back up above its 200-day and 50-day moving average. And this is where I should have been buying into Twilio, particularly as a stock that I've been trying to keep an eye on. But I missed it. So now it's back to buying on the dips. I'm not sure whether the stock is even going to come down to a good risk reward point, but that's just another hard lesson to learn. Coursera is back on my list, ticker symbol COUR. I thought I would forever forget about this stock. Just as a reminder, I thought that this breakout over here last summer was going to be sustained, and it didn't. But this is interesting. Well, look here. Let's see. I'm going to have to pull it up above the trading action. So Coursera fell. It fell significantly post earnings. I think this is over 10% or so. And the buyer stepped right in. And within a day and a half, reversed all the post earnings losses, and now it's holding 50-day moving average support. So now suddenly, Coursera gets very interesting to me, and it gets on my list, my buy list, and I feel comfortable. Sorry, let me get this scale back. Looks very comfortable. I'd be very comfortable buying into this and then maybe stopping at a new all-time low, or maybe below this candle here. That was the big 50-day moving average breakout. So it's looking very constructive. Looks like consolidation phase is starting, and it's going to be very important for it to do that because trading near these all-time lows is just very precarious. Now here's the gratifying chart that I was talking about. Atlassian, ticker symbol TEAM. Huge move. I just posted on late last week about how my model, PAROS, which stands for Panic AI Research on Stocks, gave the big thumbs up to the latest software and feature developments called Rovo for Atlassian. And I realized ahead of earnings that it didn't make sense. It made plenty of sense for me to go ahead and bet bullishly on earnings. Even though I already have a substantial amount of shares, I went ahead and bought a call spread. And looking back now over my logic, I actually should have been even more aggressive. But this is the gratifying thing. Atlassian, ticker symbol TEAM, soared 29.6% post earnings. That's this big move here. It's cleared a lot of resistance. It's now a new high because it's got above the previous peak, which was on March 6th. So it could be in the middle, like Microsoft, of starting a bottoming process, higher lows and higher highs. And it made a convincing breakout above the 50-day moving average. So, of course, it could pull back and had some struggles intraday, but it could definitely pull back. But it looks like Atlassian is going to start proving the panic wrong, at least for the intermediate term that I'm looking out over. All right. And I did take profits on the call spread. I still have my shares, and I did sell a call against that in anticipation of the stock backing and filling for a while instead of continuing to soar higher. Of course, that doesn't have to happen, but that's just what I expect. Ticker symbol AAPL, the famous Apple. I had to put this in here because it was a Jekyll and Hyde kind of day for Apple. It popped. What was this? It soared high all the way up to 287.50, which was pretty amazing. And then, but it faded hard and came all the way back to the upper Bollinger Band. So this is one of these cases where, and let me just make it clear for you here. Here is the fade part of the candle. Excuse me. And it ended up gaining for the day just 3.2%. I shouldn't say just. I mean, it's still a healthy gain, but the stock faded from the all-time high, which was back here. So that's looking a little toppy for Apple. I'm going to be watching Apple very closely. I'm not going to short it, but I do want to see whether this action will be indicative of future bearishness for the rest of the market, particularly the indices. All right, let's go to Robinhood. This is a stock that really fooled me. I wish I had missed this. I earlier talked about this nice bullish breakout above the 50-day moving average and how I was lamenting that I didn't get it at 84. Well, I got it at 84 on this pullback towards earnings, and I was rewarded with a 13.2% post-earnings loss. Hood, ticker symbol HOOD, Robinhood Markets, is now back into bearish territory because it's below its 50-day moving average. I'm going to hold my shares because I'm thinking that the stock can hold at least the lows back here at 65. But of course, if it doesn't, then I'm going to have to bail, just the rules, and just stop out of this stock. Really fooled me. OWL did not fool me. Ticker symbol OWL, Blue Owl Capital. I did a quick short on this about how OWL was shaping up to be bullish, but I wanted to see what happened in earnings. Well, earnings delivered. I was trying to get the stock at 965. I wasn't able to. I instead got it, I think, around 975 for a half position. I am holding out for a pullback to the 50-day moving average where I will buy the other half. But I think OWL is now proving itself to be in a bottoming formation. And I made the case in the short, and I laid out the case with this red box here. If it gets above the red box, then it could be off to the races from here. And the main thing, the earnings was, for OWL was very interesting. They made the case again that everything is fine. They've done some good deals in the past, particularly lending money to SpaceX that turned into equity that they cashed in on big time. So these people are very savvy operators. I think they're going to figure this out over time. I'm very comfortable buying into OWL now, and I'm hoping to build a much bigger position if the market will give me lower prices from here. All right. Robinhood Ventures Fund. I talked about this one I think it was last week. No, it was 2 weeks ago. And I said how strange it was that Robinhood Ventures, ticker symbol RVI, had fallen right back to its $25 IPO price. I jumped on it, but I wasn't as aggressive as I should have been. Soon after I got it, the stock soared, gapped up high, gained 21%. Absolutely amazing on what was this? On April 22nd. And then the big payoff was a 17% surge on April 27th. Now, despite it being well above the upper Bollinger Band, which again is this black line that defines 95% of the trading action, I decided to hold to see where it could go. And unfortunately, the stock gapped down and almost erased all those gains. So when the stock was above the 50-day moving, its upper Bollinger Band, I went in and just took profits. It's nice to see it creeping back higher, but I just don't like that kind of violent trading action, particularly when it's inexplicable. You can see the high trading volume. So this price action is very, very real. But I am keeping tabs on it. I'll buy it again if it dips close to 25 for sure. All right, I talked about Google earlier being a catalyst for NVIDIA's fall. Here's Google, big time gain, 10% post earnings gain here. And I really like how the stock has just been strong. It's the strongest now on a relative basis of the Mag 7 in terms of being able to punch all-time highs and stay strong. As a reminder, I bought Google around here because I didn't want to wait until it tested the 200-day moving average formally, and that turned out to be a fortuitous buy. And I'm still holding Google. Like I said, I'm trying to hold this one for the long term, so I'm still in the stock. Now, Meta Platforms, ticker symbol META, had a very bad Thursday. While Google was soaring 10%, Meta went backwards 8.6%, and the market was very unhappy. It appears on the increased spending that the company is going to be doing on CapEx. I doubt Meta is going to fall much further, but I also don't want to buy it. I mean, just as a reminder, Meta has just been an extremely choppy stock, going nowhere, absolutely nowhere, since the beginning of 2025, with a lot of chop in between. So that means that this stock is really a trading range stock, and right now in the middle of the trading range, it's 50-50 whether it'll go higher or lower. So I don't want to trade this at all, but I will keep an eye on it to see what happens when it gets to the lower or upper parts of the range. Let's just go ahead and take a quick look at Amazon. I do have a retail section later. I just wanted to show how Amazon went. It actually had a very odd post-earnings gain. It gapped higher. It fell all the way down below the candle from the previous day, then bounced back up, and then gained 1.2% today. This is ticker symbol AMZN. I have this trading rule that 2 weeks after earnings, Amazon at some point gets higher than its open. It did gap higher, but the selling was so immediate that I didn't have a chance to buy into it, and I was able to wait until it got negative. And I was in the green. I did a calendar call spread, and I was in the green by the close, and then the additional gain on Friday, ironically, forced me to go ahead and take profits on the position well ahead of when I wanted, well, I was hoping to take profits. But I'm not going to complain. But it's just kind of ironic that the trade that I put on that's supposed to have a 2 week runway immediately threw profits, decent profits in just one day, less than one day. All right, here's another stock that fooled me. Spotify, ticker symbol SPOT. On the second breakout above the 50-day moving average, I thought it could hold its water. It did not. It fell 12.4% post earnings. So this is another stock where I'm not going to sell into the panic, the post earnings panic. But if it does break below this low, then I'm going to have to issue my rules and go ahead and stop out of this position. And this is, again, a reminder why it's very important not to hang out here if it does break lower, because, well, Spotify could fall a whole lot lower if the selling continues. I mean, it was all the way down at 70 or around 70 just a little over 3 years ago, almost 4 years ago. Sorry. So a lot of room to fall if this stock can't hold its water here. I was really hoping that the 50-day moving average support would hold, and it did not. So that's danger, Will Robinson. Here's another stock that disappointed me. This is Roblox, ticker symbol RBLX. It fell 18.3% post earnings. I didn't have a chance to find out why the market was really unhappy and sending the stock all the way back to prices last seen November 2024. But if I look at the overall chart, this looks like a great time to add to my shares. I was unfortunate enough to hold on to shares thinking that earnings would be fine, and they weren't. And the stock is well below its lower Bollinger Band. It's kind of hard to see, but you can see buyers did step in at the low. But it's not really all that convincing or impressive. And if it does go lower, I will have to consider potentially just stopping out and taking the loss. But we'll see. I need to review the Roblox's earnings first to see whether I can see some green shoots to hang on to. All right, so back to retail, we have Wayfair. Like I said, the charts that I'm seeing, there's a mix of bearishness and bullishness. And there's plenty of bearishness, as you can see in these individual charts that I'm showing. This is Wayfair. It fell 12.8% after consolidating for almost 2 months or so. And it made a new low, let's see, going all the way back to last summer. So Wayfair, needless to say, is bearish because it is confirmed a breakdown below the 50-day moving average, and it's been held tight by the 200-day moving average. And just to remind you, Wayfair has come down a long way already. It was up around 355. It's only 65 now, 65.50. But if the selling continues, I could see it easily retesting the April lows. I mean, given the business they're in, it's amazing that they haven't retraced at least half of the gains from the April low of last year. All right, another retailer, but this one is a bullish chart post earnings. This was a bullish chart, but very bizarre. Bed Bath and Beyond, ticker symbol BBBY, gapped higher. I forgot how high this was. It went from, let's see, 536 all the way up to 773. And I guess something that was said during earnings just got people to exit the stock with a quickness. So Bed Bath and Beyond went from, I don't know, what was it, a 40% gain or something like that, all the way down to an 11.2% post earnings loss. That is about as bearish as a fade and reversal as you can get. It's a bearish engulfing pattern. Failed right at the 200-day moving average at the open. Yes, buyers are stepping back in, but this stock, let's just go back to see how bad it's been. It's struggling, and it's been struggling for quite some time. So this violent trading action should keep both actually bears and bulls away. This is just chopping around violently, and people can't decide what to make of the company in the meantime. All right, so now from retail, we go to the dining stocks, food stocks. Again, like I said, there's very bearish charts out there. And here's another one, Domino's Pizza, tried and true stock. It used to be, but it's now been chopping around for years since the pandemic in 2020. And it had another bad earnings day. It dropped 8.8%. You can see buyers are are trying to defend the stock around the lows. The stock hasn't been this low since the lows of October 2023. Now, overall, it looks like it's just going to chop around. But again, this is, old tried and true stock, not doing well and did not have good time earnings. Ticker symbol EAT, Brinker International. It did have a good day on earnings and it perfectly bounced off of this support line, which was the early 2025 closing low. And it popped, let's see, 14.4%. You can ignore this arrow here. And it's holding above the 200-day moving average and 50-day moving average. But again, it too is just been going nowhere since 2024, so almost 2 years. So it's as I've been saying, there's nothing really to do here much unless you want to just try to trade the ranges, or unless I want to try to trade the ranges. But I'm just keeping an eye on it because I think this is one of the stronger stocks in the sector. Wingstop, ticker symbol WING, had a terrible time of it. It gapped down, but the buyers did step in, almost reversed the whole post-earnings gap. Let me make it clear for you. This is the earnings reaction here, but you can see sellers started to take over again. Wingstop has been struggling. Like so many of these stocks, it's actually gone nowhere for several years. But it's a danger if it doesn't hold the lows from April 1st. It could fall a good amount all the way down to say, back to the double digits. So it really needs to hold the line here. I'm not interested in a trade here. I know there's a high short interest, so this stock is bound to just pop at a moment's notice and soar. But I do like to keep an eye on this because of the telltale signs for the retail sector. Consumer sector. All right, let's go to truckers. This is Expeditors International of Washington, ticker symbol EXPD. It has been holding its own. It has not recovered yet from that big loss. And I did a video on this. I won't go into the drivers and all that. But it is getting interesting to me as a stock that's consolidating and eventually gathering power to break up higher. So I like the way it's held above the 50-day moving average over the last 2 weeks. It's never come back to the 10-day moving average after testing it intraday. So I think this is setting up for some sort of rebound later. Looks like earnings will be later this month. So I definitely will not buy ahead of that, but I do want to keep an eye on it for earnings. Another trucking or logistics company, C.H. Robinson Worldwide, ticker symbol CHRW. You see the same pattern. The big loss day, the stock has yet to totally reverse those losses and is just consolidating in price. It did report earnings, and unfortunately the sellers have taken over, so that's not good. But I will look to see if the stock can bounce off the 50-day moving average. Ticker symbol CAT. This is Caterpillar Incorporated, very bullish, broke out to new all-time highs, 9.9%. I didn't dare trade this one from the bullish side on pre-earnings because it didn't hit any key support levels ahead of earnings. So I just thought it was a poor risk-reward thing to try out. We're almost to the end here at ticker symbol FCX, Freeport-McMoran. This was disappointing because, I'm bullish on the commodities. It fell 12.6% post-earnings, and I had just bought into this breakout and thought it could hold its water, but it didn't. Now I'm going to be looking to see if it can hold 200-day moving average support. I don't want to get chopped out of this stock again like I did last time. So I'll just hold on and see. But again, you can see that even though the overall market is very bullish, there's plenty of bearish action that's happening following earnings in some of these stocks. And then finally, this, usually I have led with oil, but I decided not to. This is fascinating to me because the market has pretty much decided not only does the war not matter, but also that the increasing prices in oil don't matter. USO, this is the United States Oil Fund, soared to another multi-year high, went up 7.9% on Wednesday. That was the Fed day. Now sellers did take it back and close that gap, but still, you can see the trend. The trend is for higher. It's not just stay higher for longer. Could keep going higher and higher. But the market doesn't care right now, but at some point it may care just because it wants to care. Who knows? But this is the context that I continue to check on, but it hasn't been meaningful to contemplate what's happening with oil prices in terms of the overall stock market, definitely individual stocks. And you can see how some of the retail stocks are weakening. And that's where I would expect the first signs of higher oil prices to be manifest. All right. I know this was a long one. Thanks for hanging in there. If you want more content like this, please go ahead and subscribe. Down below, you can provide feedback and comments. If you have any questions, you can put them down there. And of course, as always, please like and share this content because that helps the algorithm know what's up. All right. Until next time, this has been Dr. Duru with Ahan Analytics, and I hope you have a safe rest of the week. Take care.